Right. Hello, everybody, and welcome to today's webinar, where we will be talking about transferring your UK pension to Spain or Portugal using a QROPS. So I will cover the agenda very quickly. So we'll start by updating everybody on recent regulations. There's been a few changes recently, which is one of the reasons why we wanted to host this webinar. And we'll talk about the changes that came in a few years ago as well, but are very kind of valid now. Then we'll cover defined benefit transfers and the options that may be available for that, and to clarify the rules regarding the use of short-term temporary annuities, because again, that's changed very recently. Part two, we'll just cover what is a QROPS, what are the qualifying rules and the tax benefits. Then we will cover when you can't transfer to a QROPS, any common pitfalls that we come across, what happens if you move back to the UK, as often happens, and what happens when you die. At the end, we'll give a little bit of additional advice for those who are either already holding a QROPS or those who are interested in setting one up. And at the end, we will take any questions that you have. So anybody, there's the question and answer function on Zoom. Feel free to submit your questions as we go on, and we'll answer those at the end. So we'll start off, and I'll just make a quick introduction for those who haven't spoken to or met us before. So I'm a Penfold advisor and director here at Fiduciary Wealth. I've been in financial services for 20 years now. Having spent the last 4 years here working in Gibraltar, but living across the border in Spain. Paul Correa here with me today is our managing director and co-founder of Fiduciary Wealth. Paul has extensive years of experience in financial services, strong private banking background and wealth management, and in 2007 he co-founded Fiduciary Wealth Management, partnering with Islas, the oldest law firm in Gibraltar. Now, aside from our legal roots, Fiduciary Wealth is a member of MGI Worldwide, which is a top 20 global network of accountants and tax advisors. Now, our service is concentrated, but not exclusively, on serving clients in 4 jurisdictions: the UK, Gibraltar, Spain, and Portugal. And our goal is very simple, which is to offer unbiased, expert advice to deliver solutions and outcomes for our clients, which includes many of you joining us today. So we'll get into the webinar. Before I start, I'll say that today is focused on QROPS. You're either joining us live or maybe watching on our YouTube, but we're doing a series of webinars at the moment that will cover different topics. A lot of them may suit what you want. So I would ask that you like, share, and subscribe to our YouTube channel, and then you can get that content that we're offering for free as well. So if you can do that for us, we would greatly appreciate it as well. So we'll get straight into it then, Paul. And if you can start us also, I said at the start, there's new further regulations that were introduced at the end of last year that affect people looking to transfer to an overseas QROPS. Can you tell us more about that?
Yeah, no, that's correct, Matt. As you rightly pointed out, the UK government introduced the UK Pensions Schemes Act in November 2021, which enables UK pension seeding schemes or their trustees to refuse a UK pension transfer on the basis that there's increased risk of pension scamming. And yeah, that has slowed down the whole process of transferring one's UK pension benefits to a suitable overseas pension structure, such as QROPS, which offers greater tax efficiency. And while certainly in the past there's been instances of pension scamming, I think this is more a move by the UK pension industry lobbying the UK government, because they've seen huge capital flows moving from the UK pension industry overseas, and they've tried to stem that flow. So yes, the processing times are getting much longer, and they're asking for enhanced due diligence, some of which is perfectly acceptable, but other times, you know, there's a drive to slow down the process and make it as cumbersome and awkward as they possibly can. I think, but you can correct me, Matt, but I believe the UK government has already indicated that they will review the Act to make sure that it serves the right purpose and it is not misused by seeding schemes.
Thanks, yeah.
And ultimately, it depends on the seeding scheme. It depends on us as the advisory firm, making sure we're diligent and on the ball, getting all the documents through. But yes, it requires good work from the seeding scheme. And then there's the receiving scheme, the QROPS trustees. They have to play their part, and they will also require more due diligence to try and get this through. So all in all, it's proving quite difficult to get those transfers through in a short period of time, which is why delaying it makes no sense, because in any event, it can take a long time. Much longer for a defined benefit scheme than for a SIP. But each case is different.
Yeah, I think it's a much more arduous process, taking longer, and it seems to be moving in that direction.
Exactly.
And those regulations, they're more recent, but the overseas tax charge is something that's been with us for some time. Can you tell everybody a bit more about that, please, Paul?
Yes, the overseas transfer charge was introduced in 2017, I believe. And again, I think it was driven by the UK pension industry wanting to stem the flow of pension capital outside the UK. But also the UK government has a vested interest, Matt, because if you think about it, they are providing tax relief for those contributions. And when they are about to collect their dues in terms of tax on pension income, they transfer it out and they lose out on the tax revenues.
Yeah.
So both the UK pension industry and Her Majesty's Revenue and Revenue Service had a vested interest in putting blockers. So the overseas transfer charge is effectively a 25% tax charge on UK transfers to non-EU EEA countries. And by EEA, I mean all EU countries. And then the EEA countries, I think, are Liechtenstein, Norway, Switzerland, and Gibraltar.
Yeah.
So those countries were exempted. All the others would be liable to the OTC charge unless the pension trustees were based in the same country where your tax residents. So I'll give you an example.
Yeah.
Let's say that, Matthew, you decide to move from your base in Nottingham to Kenya, Nairobi, Kenya, and you want to transfer your UK pension benefits across. Then, unless there's a Kenyan QROPS with the trustees operating out of Kenya, which is highly unlikely, you would be liable to the OTC charge. So, although there's an exemption of when the trustee and individual and the member is tax resident in a particular country, in practice, it rarely is. There's only 4 or 5 jurisdictions globally that are specialists in this field. So, whilst the OTC charge was implemented in 2017, and they had to exclude the EU and the EA for a simple reason, Matt. As you know, the UK was in the EU in 2017. They were subject to the 4 freedoms, one of them being the free movement of capital. And had they applied this charge to a UK pension transfer to anywhere within the EU/EEA, they would have been in breach of the EU law. So they were unable to do this. But now, having Post-Brexit, it's a new reality. And you know, there's an acrimonious relationship between the UK and the EU with a lot of outstanding issues. And it's a tense relationship. So nothing to stop the UK from extending this charge to cover the EU. And this is why we always urge that, you know, procrastination would be a mistake. It's important that people move quickly.
So those who've already transferred, they're okay.
Exactly.
Those who are close to considering it, we don't know what will happen, but there is a chance that that door could close.
Absolutely.
Or at least they would enforce this 25%. And when we talk about the EEA, what we're saying is the pension and the individual both have to be located. So somebody couldn't transfer their pension, say, to Malta, which we'll talk about, and live in Kenya. They have to have their pension in Malta and live in Portugal, Spain, France, in Europe. Okay, wonderful. And then what about defined benefit transfers? You mentioned that they're taking even longer at the moment, and there are certain UK rules around that. So what are the issues surrounding that?
UK pension transfers, I mean, there's no issues other than the ones I mentioned, which relate to the UK Pension Schemes Act 2021. But defined benefit schemes have been clamped down by the Financial Conduct Authority in the UK. And quite rightly so, because we had the British Steel fiasco, where clients were harmed by being pushed towards transferring their final salary schemes into SIPs. Like everything else, there's pros and cons, and you have to look at each individual case to assess whether it's to their benefit or not. And sometimes there's a trade-off, right? Of course. And you can't really generalize. But clearly, the Financial Conduct Authority has tightened the rules, and now this requires an independent advice report, and which always comes out as negative: do not transfer your pension. Yeah. But simply because the writers of the independent advice report do not have professional indemnity insurance cover. It's an exclusion. So inevitably, the conclusion will always be do not transfer, because otherwise they are running with an exposure. Yeah, of course. And then the client has to proceed on the basis of being an insistent client. So yes, defined benefit schemes for the time being are still transferable, but it's becoming more difficult. I'll try and cover another aspect of defined benefit schemes, which relates to CETVs, which are cash equivalent transfer values. I'll do that later on if you don't mind. Yeah, no, but I mean, yes, defined benefit schemes, if it's difficult enough to affect a normal transfer SIP, you can imagine that the defined benefit scheme requires more. Yeah, there's more levels and barriers, yeah? Yeah, so again, it's still possible, but it takes longer, it's a more painful process. But like any pension transfer, it needs to be looked at on an individual basis. I think you mentioned that, Paul, and for some people it's the right move, for some people it's not the right move, and that's why there can't be a blanket, you need to do this, you need to do that. We need to speak to people on a one-to-one basis, assess your situation, your overall situation as well, and that can be reviewed. For those who are interested, feel free to reach out to us. So QROPS, we're talking about somebody may hold a QROPS in Spain or Portugal, and there's a possible using a short-term temporary annuity for tax advantages, which we will cover a little bit, but they recently clarified the rules regarding the use of these in Spain and Portugal. Is that right? Yeah. Well, let me address it in a slightly different order, but covering all aspects. Yeah. So in Spain, the amount of tax, well, in Spain anyway, but since we're talking about Spain, the amount of tax you pay will cover Portugal too. Yeah. But in Spain, the amount of tax you pay on pension drawdown depends ultimately on whether the pension contributions which funded your QROPS scheme suffered personal tax in the UK, or were in effect a benefiting kind from the employer. So they draw a distinction between employee contributions, which are after-tax contributions towards the pension scheme, and employer contributions, which are, in the eyes of the law in Spain and Portugal, they're deemed benefits in kind. For contributions which are paid by the employee net of salary, you can structure them as a short-term annuity. And then the tax you pay depends on the level of pension drawdown. It depends on how the annuity is structured, the term of the annuity, and then the progressive tax rates in the autonomous region where you base it. Because in Spain, there are marginal differences across the country depending on the region. But it tends to be with an annuity in the region of between 2 and 6. Yeah? That is the range based on the variables that I've just described. But you're right. It's important to emphasize that the rules have been changed, or whether they've been changed, or whether they've decided to interpret them differently quite recently. And they no longer allow short-term annuities to be renewed. Before you had a 2-year annuity, a 3-year, 5, and each one, you know, the shorter the annuity, the lower the tax, but you can renew it. That brought down the overall headline rate of tax. But now what they're saying is you can only do one annuity, and therefore the advice we give now is to do an annuity and fix it for 30 years, because, you know, you have to almost, you know, play the role of God, yeah, and determine, you know, how long you're going to live.
Yeah.
But you give it maximum term possible, but you have to factor things like, what do you think is going to be the maximum pension drawdown 20 years from now? So you need to think about inflation and how that reduces the purchasing power of money. You need to factor in changes in the tax rate. You need to consider your income requirements going forward, depending on your overall net wealth. And you have to make a calculation and determine, in year 20, when I'm 80, I will need X. And sometimes you have to draw more than you need now.
Yeah.
To ensure that you keep that headline rate as low as humanly possible. Because if you do a short-term annuity of 3 to 5 years, when it matures, the annuity route is closed, which means you pay a progressive tax rates. So it's a pain worth suffering, in my opinion. And then if your contributions have been paid by your employer, then unfortunately you're taxed at your marginal rate based on progressive tax rates. And then you can have an anomaly, and I don't think anomaly is the right word, but because I think it's more commonplace than what we think. There could be a combination of employer and employee contributions, which complicates the whole issue.
Or the consolidation of pensions.
Or pension consolidation, which is commonplace again. And the tax treatment is more difficult to foresee, because sometimes if they open the bonnet and they look inside and they distinguish between employer and employer, but other times they don't. Especially if there's been transfers across different schemes and consolidation. So in instances like that, we need to get a tax advisor in Spain to issue an opinion, and then you either disclose everything to the tax advisor and they calculate what it is likely to be, or you apply for the annuity hoping that they will honor it, and based on the fact that they cannot see any employer contributions. But it's a bit less clear.
It's a bit grey, as
it's a bit grey.
Often can be the case with Spanish taxation.
Exactly. And then let me cover Portugal for the benefit of some of the listeners. The rules are fairly similar, again depending on who funded the pension benefits, employer or employee. For contributions which have been made by the employee from net salary after suffering tax, they can avail themselves of a short-term annuity. And then the tax they would pay would be 1.5% for 10 years under the non-habitual residency regime, and between 2.175% and 7.2% post NHR. Again, between those ranges, 2 and 7.2. Again, it depends on the income that you drop down in the tax year you're being assessed. Yeah.
Yeah.
But the reality is it keeps the tax really, really low, which is great. I think there's only one minor yet significant difference between Spain and Portugal. Portugal still honours and accepts that you can renew your short-term annuities. So effectively, you don't have to fix it for 30 years. You can still opt for short-term annuities.
No.
Having said this, Matt, we must not forget the fact that Portugal tends to follow Spain. So whatever Spain does, they will lag them, but very often they will copy-paste the rules and regulations and apply themselves. So I wouldn't be surprised if they latch onto that and they were to ban short-term annuities from being renewable, as they do in Spain. That is entirely feasible.
Yeah, quite possible. I guess the only difference is that in Portugal, they assess 15% of the income is taxable, and that's regardless of the term, whereas Spain based it on the length of the term, hence why they probably kind of tightened this.
I have deliberately not gone into the years and the tiers to keep it as simple as I can. But you're right, we could delve deeper into the subject and explain the nuances between Spain and Portugal. And there are some nuances, but they're not significant, but they're well. But I would think that the best way to deal with this issue is for individuals to approach us after the webinar.
Absolutely.
And then we can go into greater detail.
Absolutely. And just the kind of final one, we talk about annuities. It's not your typical annuity that the Brits know, as in you go and buy an insurance contract. You still retain your pension, your assets still grow in value. It's just that income is designated in a certain way.
I think the language has to be interpreted very loosely. It is not a UK annuity contract.
Yeah.
It is for the purposes of those living in Spain and Portugal that it is deemed as an annuity if you fix it. But you're not forfeiting your pension and then getting an annuity for life.
So it's a nice combination. You still got the pension group, but the
Absolutely.
but only available via the QROPS as well. It's not something that can be used.
Only by a QROPS. So those individuals which we come across and they want to maintain their UK pension. In fact, I had one only 3 weeks ago, before we started traveling again, and he insisted that he wanted to keep his UK pensions intact in the UK, but avail himself of annuities in the country of residence. It just doesn't work like that.
Some people want the best of both worlds, don't they? But if life was that easy. So, so a QROPS, so we covered a lot of the technical details already, and maybe I'll take a step back. So what is a QROPS? So it stands for a Qualifying Recognised Overseas Pension Scheme. They were introduced in 2006, and the purpose was to allow expats to take their pensions with them when exiting the UK. Maybe HMRC are regretting introducing that after we talk about the outflows. It's important to understand the qualifying rules and how you can use a QROPS. Now, Paul's covered that very nicely earlier in the centre. It's based on your residency. So we're talking about Portugal and Spain today. So your QROPS needs to be held in an EEA country. Now, Spain and Portugal don't have QROPS themselves. So the most appropriate jurisdiction to use is Malta. The main reason for that is the double taxation agreement between Malta and Spain and Malta and Portugal, which means that you can take advantage of the QROPS and the income in Malta is paid gross. So you're a Spanish tax resident, your tax obligations are in Spain, so that works out very, very nicely. So if you want to use a QROPS, it's important that it's an approved scheme. So it's an overseas pension scheme, but these still need to be approved by HMRC. HMRC do issue a list of all the approved schemes. There were schemes in Guernsey before, and they were delisted. So you've got to make sure it's in an approved QROPS. And these are designed for expats, hence they were introduced. And the purpose is to transfer, use a QROPS to transfer your UK pensions. So there is a similar product called a QROPS, and coincidentally we did a webinar about this yesterday. So if you're interested in that, it's highly different, but please visit our YouTube channel, or if you're already on there, have a view of that and show your appreciation by liking that. So the benefits of using a QROPS. So a large one is for those who are close to the UK lifetime allowance. So the UK lifetime allowance is a limit of how much we can build up in our UK pension benefits. The limit now stands at 1,073,100. The limit was previously up to 2 million and was reduced in stages. So there may be people who have protection above the current limit. But effectively what the lifetime allowance means is that if you breach that limit, then you will pay a tax charge on that. It's a 25% tax charge if you take that by your income, and 55% as a lump sum. And the lifetime allowance is measured or tested by what they call benefit crystallization events. So your pensions will go for a benefit crystallization event at some point. Usually that's when you start taking income. The final one is when you reach 75. So if you haven't had an event, then 75 is the ultimate date. Another time is when you transfer your pension to a QROPS. So the reason we mention that is for somebody close to breaching that limit, or even if you're already over that limit, you transfer your pension to a QROPS and the benefit crystallization event happens. Perhaps a great example, if your pensions total £1 million, then there's no tax to pay. And you had that benefit crystallization event. So what that means is your pension can remain invested, continue to grow in value, it can go over the limit and beyond, and there's no additional test. So if you go over that limit after you transferred your pension to a QROPS, then you can avoid paying that tax charge. So for those watching this who are close to that limit, considering a QROPS, you know, time is not on your side. It's better sort of this sooner rather than later. And even if you're already over that limit, your pension is likely to grow in value. So if you have the opportunity to transfer, look at that now. And you may have to pay an amount of this excess tax charge, but you will limit it because the growth that you have after that. Now, the other benefits of using a QROPS is they're more generous death benefits. I think Paul, you're going to cover that a little bit later. But a QROPS is outside of your estate for UK inheritance tax. You could use a QROPS as a consolidation exercise. So it's not simply I transfer one pension to a QROPS. You can actually consolidate all your UK pensions into one if you're moving overseas. You have a wider choice of investments in the UK scheme and wider options on currency. So if you're living in Spain and Portugal, you really should have your assets held and paid in euros to avoid currency risk. But also a typical UK pension would have access to UK funds, whereas a QROPS would have access to more international funds alongside those UK ones. There's also the fact that as soon as although QROPS is a HMRC approved scheme, once you transfer it, it's out of UK legislation. So if there are future changes, if they were to reduce the lifetime allowance, again, similar changes, and who knows what will happen. All we know is that central governments need to recoup a lot of spending they've had over the last couple of years, and maybe pensions will be something they target. if you can transfer your pension to a QROPS, and it's outside of UK legislation, so you're kind of shielding yourself for potential changes. And then, of course, the income benefits when you draw income, which Paul has summed up very nicely. So there's a range of benefits to using a QROPS. Again, and we repeat this, but it's very important to take into account. It depends on your individual circumstances. You can't go on Google and say, the QROPS is perfect for me. This webinar we think is very informative, but you need more information. You need a one-to-one conversation with us, so feel free to reach out to us. So we move on to the next part, and when can you not transfer your benefits to a QROPS? So we've covered some of those options, and your residency is one of those. So again, we're talking about Spain and Portugal here, so you need to ensure that pension, if you are using a QROPS, is based in the EEA. Another very important one is if your pension is in drawdown. By that we mean you're taking income beyond the tax-free lump sum. If you're only taking your tax-free lump sum only, you still have the option. If you started to take income, then the door to transfer your QROPS is closed. So that's something to bear in mind. Again, if you're planning on relocating and you're considering accessing your pensions. So in that instance, what are your other options? And this is something I don't think we should go into detail today, but there is an international SIP which would be available to transfer if you're already in drawdown. Now, again, if that's something you need information on, there's information in some of our webinars, or we can have a one-to-one chat with you about that. And then we talk about kind of common pitfalls, and there's a few, but they all kind of sum under the same thing. It can be a complicated process. The rules and the legislation is changing quite often. We discussed that it can be quite painful, and you need to ensure that if you are doing something like this, you're working with a company and an advisor who know what they're doing. It's a complicated process. They need to understand UK pensions, they need to understand the QROPS, they need to understand the taxation in the UK and your new country of residence. So that is very key, and I'm going to steal your phrase here, Paul, if you don't mind, but Paul always says, don't be penny wise and pound foolish, and what Paul means by that is people are trying to do things a quick fix, an easy way. Let's use Google or Facebook, or I've been approached by this advisor, and he's very cheap, although I'm not convinced he knows what he's doing. You can save a little bit of money there, but you will be paying for it further down the line. So make sure you do things properly and take the proper advice. Another common pitfall is related to what I was saying before, waiting until you're over the lifetime allowance. If you're close to reaching that limit, I repeat, you should be considering that now. Using unapproved schemes, of course, you shouldn't do that, and using the wrong jurisdiction. But it all ties into that key part. Make sure that you get the proper advice before doing this. So we move on to the next bit, and Paul, I'll pass back to you. So, okay, somebody's relocated, they've enjoyed their life in the sun in Spain or Portugal, they transferred to a QROPS, but they might go back to the UK, which we often say. What happens then?
Well, if you move back to the UK, you've got two options, right? You can retain your pension assets within the QROPS arrangement. However, the tax you pay on any pension drawdown is based on UK tax, but only a progressive rate of tax.
Yeah.
So you keep the pension assets in situ within your QROPS. And I would imagine that if you've been outside the UK for long enough, which I think is 5 complete tax years,
Right, yeah.
then you still benefit from the tax advantages of keeping it within the structure, correct?
Correct, yeah.
So there's an argument for keeping it as it is,
Yeah.
notwithstanding the fact that the tax you pay is based on your new reality, which is that you're tax resident in the UK and subject to tax at a higher marginal rate.
Yeah.
That's just in industry. The other option, of course, Matt, is that you transfer your QROPS back into a SIP, which you're perfectly entitled to do. But then if you've had it for a long time, you are forfeiting some of the benefits which you have locked in.
Yeah.
So again, no right or wrong, sitting down with a client and assessing the options and making sure that the advice and the route that is taken is the most advantageous for the individual.
I guess the key takeaway though is if somebody is moving to Portugal and Spain, they know that if they take advantage of the QROPS, there's still options if they return to the UK, which I think is always important because we never know what's going to happen in life.
You're quite right, and I think from past experience, people want just the comfort to know that should, for whatever reason, they would return to the UK, then rather than be locked in with no option to move out again, that flexibility exists, even if it's not exercised.
Yeah.
It gives you that peace of mind that you're not boxed in. Yeah. This is I think the experience we have. People want to feel that they're not boxed in, even if they don't exercise that option.
Absolutely. And what about if someone's holding a QROPS and they pass away? Or what happens in that situation?
Well, I think that's that's not much more complex. If the spouse, let's assume for the purposes of this webinar that it's a couple that have moved from the UK to either Spain or Portugal, and the husband is the member and he passes away, then the spouse or the life partner, whatever the case may be, has been nominated as the beneficiary when they do the nomination of beneficiaries on the QROPS already. So if the surviving spouse or the beneficiary remains in the same country of residence, be it Spain or Portugal, then they are allowed to draw pension income in the same tax efficient manner through the use of annuities or not, depending on how it's been funded. Yeah, but they will not be disadvantaged in any way, shape, or form. They can still draw their pension income and be taxed at the same rate as the husband, assuming the amounts are the same. If the spouse decides to collapse the scheme and then receive the lump sum payment all in one go, then the tax consequences are going to be severe, right? And that is not the idea of having a pension arrangement. You have to understand that you're taking it and then you will hit the marginal rate, and it is not a good, sound financial decision to make.
Which is the case for any pension, not just for QROPS.
For any pensions. It just doesn't make any sense, particularly in countries like Spain and Portugal. That is not the intention. And then there's another scenario. Let's say that the surviving spouse passes away, and then the children are the nominated beneficiaries, and the children happen to be based in the UK. So on the death of the first beneficiary, the surviving spouse, and provided they have been non-UK tax resident for 5 complete tax years, my understanding is that the beneficiaries can take the lump sum, yeah? Free of UK IHT.
Correct.
And am I not right in saying that with a UK pension, if the member were to pass away, the beneficiaries, he or she were to pass away after the age of 75?
Correct, yeah.
Then the beneficiaries, the nominated beneficiaries, could draw income, but they would pay tax at the marginal rate.
Correct, yeah.
So I think that's a bit of I won't say a con, because it's not advisable to have a recorded webinar and making these allegations, but I think SIPs and UK pensions are promoted on the basis that they are an excluded asset from your estate for UK inheritance tax purposes. And whilst that is correct, what people don't realize is that ultimately tax is paid at some point. If the member were to die after the age of 75, the beneficiaries will pay tax when they draw on that income. So it's not completely free.
No.
So there's a distinct advantage in transferring to QROPS because it is you can really the beneficiaries can really take the lump sum completely tax free, which you cannot do in the UK.
Exactly.
And as you know, we have no preference either way because we're UK advisors too, and we've got licenses to offer UK pension advice and to manage SIPs. So we are completely agnostic, but we have to highlight these nuances and differences, which sometimes are kind of glossed over by many individuals. They don't really look at the detail, yeah?
No, I think the pension one in the UK is often missed, and yeah, your pension, your UK pension is outside of your UK estate for inheritance tax, true, but you pass away after age 75, they pay tax on it.
Correct.
And given the average age in the UK, I think it's 83 now as well, so the majority of people, so with the UK scheme, you pass away under 75, your beneficiaries can take everything tax-free. If there's a QROPS, as long as it's been out for 5 years, doesn't matter what age you pass away, your beneficiaries can access
So
it.
a bit of a light note, you have to make sure that between the ages of 65 and 75, your spouse doesn't poison you. So you have to be a bit more vigilant during that period of time.
I better tell my wife tonight just to be on the safe side.
Exactly.
Yeah, I don't know what she's planning. Perfect. So we'll get to the last section. So what advice do we give people who already hold a QROP? So that's an interesting one because there will be people watching this who are already in Spain or Portugal, they hold a QROPS, and I think from our point of view is always worth taking a second opinion, even if it's just for the comfort that you are on the right track, or to explore the opportunity to improve the performance of your QROPS, or to make sure that it's established in the right way. Now, if there's any concern that your QROPS hasn't been established the right way, or if you have non-mainstream investments within that QROPS, then we would urge you to seek a second opinion, which we can offer urgently. I mean, one thing I see a lot, Paul, and this is always the difference, is the use of a bond within a QROPS. Now, if you have a QROPS and the advisor you're using suggested using a bond within the QROPS, or you have a bond within the QROPS, that to me is number one warning sign that it's not being established properly, and you should certainly get a second opinion. But markets are very volatile at the moment, and we talk about the structure, but it's important that the underlying investments are performing well, so your pension can continue to sustain your life and retirement, and your beneficiaries can inherit that. So it's important on that side that you're getting professional advice. So I think that would be our advice to those who are already holding a QROPS form. Yeah. And so I covered that side. What about those who are considering transferring their UK pension to a QROPS? Paul, what's your key advice to those people?
I think it's a very good question, Matt. If I had to give one piece of advice, it would be not to procrastinate. And the reason why I say this is I go back to what we talked earlier. Yeah. One, the UK government may extend the OTC charge of 25% to on a post-Brexit basis to EU, EEA territories, because Britain is no longer subject to the free movement of capital. So that is a distinct possibility. Of course. And one hasn't got to assume that the OTC charge is now crystallized and fixed, and they're not going to extend it to the EU. If the relationship deteriorates, that's one area where there could be a tit for tat, yeah? They could really hit back at the EU. And the secondly is the UK Pension Schemes Act 2021, which is slowing down the transfer process completely. And you know, it can take up to a year to transfer those pension benefits. So, you know, those who say, I want to think about it, I want to delay, I want to hold back, you know, let's wait a bit more, and a bit more. They shouldn't delay because, you know, perhaps they want to then, we have loads of cases going to Spain and Portugal and say, but I want to draw. Well, we're in the process of now, so they cannot draw, because once they go into drawdown, it invalidates a transfer to a QROPS. So they haven't got access to the pension fund, but they have to wait a year to transfer it to a QROPS and then to start drawing. So because it doesn't happen instantly. This is not like, you know, frying an egg. The process is long and arduous. I think people have to understand that it is long and arduous.
And it's a process someone can start in the UK as long as their genuine intention is to
completely. If they're in the UK and the intention is to relocate within 12 months, then they can get the ball moving. And so long as they're genuine, they have to sign a disclaimer, because we don't want to be aiding and abetting someone who has no intention of leaving. Right? It has to be done in a proper manner, in the spirit of the rules. Because we are an approved pension advisor in the UK as well, and it has to be done correctly. Two other things which I think makes me think that procrastination is not a good idea in terms of UK pension transfers is the UK Financial Conduct Authority, as I mentioned earlier, tightening the rules on defined benefit or final salary schemes. An outright ban on final salary scheme transfers cannot be ruled out completely. And then fourthly, and worth mentioning, is cash equivalent transfer values. For those with pension statements, you will see they use the acronym CETV, cash equivalent transfer values, only for defined benefit schemes. And you probably have seen that in recent 6 months, those transfer values have dropped significantly because UK interest rates are rising, which means that UK gilts are moving higher, and it is the higher UK gilts which reduces the transfer values. And whereas there could be a pivot by the central banks and they might start reducing rates sometime in 2023, right now, those transfer values are being decimated by the Bank of England's aggressive monetary tightening stance. So I think I've given you 4 reasons why procrastination doesn't make any sense. Not in this environment, at least.
No, absolutely. And you need to understand what you're doing properly. That's why you need to have a conversation with us. But taking your time is not the right move on this. Do it properly, do it right, but let's get the ball rolling as soon as possible. So wonderful. So we've reached the end of the webinar. Thank you for those who've been watching. Normally here we will answer the question and answers, but there's no questions for us all today. So I guess that means we've explained it expertly.
Well, I was going to say that either we've explained it expertly, which is what we would like to think. Alternatively, the listeners are a bit shy to pose any questions. But whatever it is, you know, we're always here to take questions, and if it's not here, you're more than welcome to reach out to us by email.
Absolutely. So email. Our email is inquiries@fwm.gi, or visit our website. We've got all our contact details on there. If you're watching this live or watching this via our YouTube channel, please like, share, subscribe, and there'll be more free content coming your way. But apart from that, we say thank you for those who've been watching, and I'm sure we'll speak to some of you soon. Okay, thank you. Bye-bye.
Bye-bye.